Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this segment is dedicated to keeping you informed about what's going on in the current market environment. And we certainly have a lot to talk about because we had a bit of an erratic fourth quarter with the stock market, so let's jump right in. Well, what a difference 12 months can make. At the start of 2018, investors appeared confident that growth was spreading throughout the world. Riskier parts of the markets were rallying, and posted strong returns in early 2018. And President Trump had campaigns on an American First platform that threatened tariffs, but nothing concrete had been done yet. And volatility was near historic lows. But 2018 is changed rapidly, and it's really going to go into the books as a year when the markets began to transition away from a low volatility environment into a much higher volatility environment. A lot of things changed throughout the course of 2018. First, we can no longer rely on low interest rates to propel the stock market forward, and the geopolitical environment deteriorated quickly. Tariffs were slapped on China, prompting a trade war. Europe was caught in a crosswinds of populism, with Britain still trying to figure out how to exit the European Union. And the U.S. government shutdown also caused a lot of tension with investors because it's estimated that for every 2 weeks the government shut down, about 0.1% is shaved off of gross domestic product. And in addition to that, due to the government shutdown, many key economic numbers have not been published. And so we've been in this period of time where we're not getting a lot of the data that the markets are used to getting. So this caused quite a bit of troubles in the fourth quarter, and we saw an extremely volatile few months that we had to live through, very gut-wrenching at times. Let's take a look at what that actually looked like. So this chart shows the S&P 500, which is a measure of domestic large-cap stocks, through the full year of 2018. And the yellow shaded area there shows the movement of domestic stocks in just the fourth quarter. And the thing to note here is that green line there, those are zigzag lines, such that every move of at least 5% up or down makes a zigzag on this chart. So what you can see here is in the fourth quarter alone, we saw 6 moves of at least 5%. The S&P dropped about 19.8% from its high in mid-September, which is just shy of bear market status. And the Russell 2000, which is a measure of small cap companies in the United States, it did fall into a bear market over the course of the last few months. So in 2018 here, what you can see is very, very erratic fourth quarter. We had weeks where the market was up 5% in the matter of a week, which, as you know, in some years, that's a whole year's worth of return. So very difficult trading environment. Let's look at this quickly over a longer time frame. So this chart goes back to 2013, so showing 6 calendar years of data. What you can see here is that usually those green lines, those moves of at least 5%, usually you see moves downward occur maybe once or twice a year. And in 2017, which is the second frame from the right, we saw no moves of that magnitude. And then we had 9 in calendar year 2018. So very, very volatile environment, sideways environment, which makes it an extremely difficult time period to invest in. And one of the things I'm not showing here is that fixed income markets were volatile as well. In the last 7 weeks of the year, we retraced 10 months of moves in the treasury markets. So the bond markets were not immune to these fluctuations either. So the difficult part of having this high volatility regime is that asset class returns in 2018 were very difficult to come by. This chart, courtesy of JP Morgan, shows asset class returns in every calendar year going back to 2004. And if you just kind of note the colors there, each color represents a different asset class. Whatever is in the top row of this chart is the asset class that performed the best, and whatever's in the bottom row of the chart is the asset class that performed the worst in that particular calendar year. And the interesting thing here is clear on the right, on calendar year 2018, the best performing asset class was cash at about 1.8%, Fixed income returned zero, REITs were down, high yield bonds were down, large cap, small cap, commodities, developed international markets and emerging market stocks all down for the year. So what we have here is a period of time in which traditional diversification strategies were ineffective because outside of cash, few asset classes, actually really none at all, none of the major asset classes offered a safe harbor like you've had before. So even in volatile periods like 2008, if you go to the left side of the chart there, even in 2008, the market was a little bit easier to invest in because something was at least going up. Fixed income was going up. In 2018, that was not the case. And if you look back historically, in terms of how the returns played out for the calendar year, returns haven't been this hard to come by since the early 1970s. So this was one of the toughest markets for investors in nearly half a century. So if you've been disappointed by returns and what you saw in the last year, it is because what happened in the last year is quite rare. The white box going across the middle there that says asset allocation, that represents the performance of a balanced portfolio. So an investor has more of a moderate allocation, about 60% stocks, 40% bonds. In 2018, your moderate type investor that's well diversified across multiple asset classes, according to JP Morgan's calculations, had a return of about negative 6.8%. So again, a very disappointing year overall for the markets. So what do we see looking ahead? Well, first, the macroeconomic risks remain high. Global growth remains positive, but has become more uneven. And the outlooks for major economies are more varied, which is likely to continue to stir up continued market volatility. Additionally, trade tensions remain a source of uncertainty. Now, there is about a 90-day ceasefire in the trade war right now, and there's going to be meetings next week concerning trade, so hopefully we'll see some positive outcome there. But until then, that remains a big source of uncertainty for the markets. So that's on the bad side. On the good side, the risk of a U.S. recession in the next 12 months remains low. U.S. consumers are continuing to benefit from improved job conditions, and GDP growth is still positive, and it's still around 3%. So the definition of a recession is a negative GDP for at least 2 consecutive quarters. And we're not really close to that right now because we're still at a positive 3%. And in addition to that, the leading economic indicators are fairly positive for that number. So we do think that the risk of a U.S. recession in the next 12 months is low. The other good news is that both domestic and international stocks are undervalued relative to their 25-year historical average. So there are some returns to be had, especially after the major pullback that we've seen over the last few weeks. And we will continue to look at the portfolios and make changes as warranted. As we are this late in the economic cycle, it does become more and more difficult to earn returns. Volatility does tend to increase, and so we will change the portfolios as warranted. But in the meantime, we hope that you have a great 2019, and thank you for your continued comments.